Hi there. In this video, we'll explain when software development costs may qualify for R&D tax relief in the UK.
Last year, the UK tech sector claimed £7.6 billion in R&D tax relief. But as this chart shows, accessing that capital now comes with a high risk of triggering an HMRC AI-driven audit. HMRC is actively rejecting thousands of software claims. Their automated systems are identifying and flagging applications that lack deep technical evidence and rely too heavily on generic product descriptions. At Pro Tax Accountant, we see the financial fallout of these rejected claims every day. We exist to demystify complex tax legislation, ensuring tech businesses can secure their funding while complying with HMRC's stricter evidentiary standards. The question every founder and CTO has to ask is whether the software development costs they incur every month actually qualify for relief under the current UK rules. Building a highly commercial, user-friendly SaaS product does not automatically satisfy HMRC's strict scientific criteria. Commercial success and technological advancement are measured on entirely different scales. The absolute baseline for a valid claim is proving your project overcame technological uncertainty, meaning your team faced a technical problem that a competent professional in your field could not easily solve. We are going to walk through the active financial schemes, how to properly track your engineering costs, and the specific legislative traps that will instantly void your claim. Understanding the precise boundary between routine commercial engineering and statutory R&D is the only reliable way to access non-dilutive capital safely. A valid R&D claim requires an advance in the overall field of computer science. Improving your own company's internal capabilities or learning a well-documented framework does not count. This matrix breaks down the exact division between routine commercial coding and qualifying R&D. Look at the system integration row. Connecting a payment gateway using a standard API plugin sits on the left. Building custom communication protocols because two legacy platforms inherently reject each other moves you to the right. Warning: to stay in that green column, you have to prove system uncertainty. This requires meticulous documentation of your failed iterations, performance bottlenecks, and the technical struggles your engineers faced. A major legislative update in the Finance Act of 2023 officially classified mathematical advances as science for tax purposes. This specific classification protects companies working in artificial intelligence, machine learning, and cryptography, aligning their core algorithmic work directly with the relief criteria. HMRC does not evaluate the final feature you ship to your users. The tax relief pays exclusively for the technical struggle required behind the scenes to make the software function. Once you establish technical merit, your actual payout is determined by the financial rules of the new merged scheme introduced in April 2024. This chart shows the exact mechanics of the merged scheme. You receive a 20% taxable credit on qualifying spend, which nets out to a cash benefit of between 15 and 16.2% after corporation tax. While this scheme universally applies to most companies, standard SMEs no longer receive the massive 130% cost uplifts of the legacy era. There is an alternative track for highly innovative loss-making startups, the ERIS scheme. To qualify for ERIS, your financial profile must look like this pie chart. Your qualifying R&D expenditure must account for at least 30% of your total company spend. Hitting that intensity threshold yields significant upside. The standard 15% merged scheme return is dwarfed by the ERIS benefit, which yields up to 26.97% of your costs as a cash payout. Maintaining that ERIS status requires strict financial monitoring, as missing the 30% threshold in a given year kicks you back to the lower rate. Selecting the correct scheme and proving your eligibility determines the absolute maximum cash you can extract to fund your next development cycle. The primary expenditures that feed these calculations are staff salaries, specific software licenses, and up to 65% of your UK subcontractor costs. Cloud computing and data licenses are also eligible, but with a strict condition. They must be used directly for testing and development environments, not for hosting your live commercial product. Advisory: to satisfy HMRC, you must enforce strict time tracking and environment tagging to strip out non-R&D overheads like UI and UX design. This creates an immediate operational clash. The way modern engineering teams build software using agile methodology rarely matches the statutory language HMRC expects to see. Tracking your R&D claims at the sprint level is a fatal administrative mistake. Sprints track the delivery of commercial features. They do not articulate technical problem solving. This workflow tree illustrates the correct solution. You must map your R&D activities at the epic level. Epics naturally capture the overarching architectural bottlenecks and system integrations that satisfy the law. Translating developer JIRA tickets into HMRC-compliant Epic documentation is the critical operational bridge that secures your claim against an audit. Even with perfect tracking, the 2024 legislation introduced high-risk traps that can instantly invalidate a claim, starting with offshore development teams. The rules on overseas workers are now incredibly strict. Costs for offshore developers and international agency workers are generally no longer eligible for relief. There is a very narrow exception. You must prove it was physically or regulatorily impossible to perform the necessary work inside the UK. As this map illustrates, HMRC explicitly rejects commercial excuses. Using an overseas team because developer rates are cheaper or because talent is easier to find instantly makes those costs ineligible. The second major trap targets B2B software agencies through the new decision-maker test for contracted-out R&D. If you act as a subcontractor and your statement of work does not explicitly state that you hold the technical risk and retain the intellectual property, your end customer gets the right to claim the relief, not you. Executing highly complex R&D without updating your vendor contracts and offshore resourcing strategies means you are legally forfeiting your tax benefits. Software development can yield a cash return of up to 27%, but only through a rigorous translation of engineering realities into statutory compliance. This quadrant chart maps the ideal claimant profile. The top right pro-tax accountant safety zone is where you want to be. Startups building novel AI models, scaling companies solving deep database latencies, and businesses pushing computer science boundaries. If you operate in the lower left quadrant, building standard websites, relying entirely on off-the-shelf APIs, or focusing solely on UI design, you are firmly in the audit risk zone and should avoid claiming. Successfully navigating the new advanced notifications, additional information forms, and decision-maker tests requires specialized expert intervention. At ProTax Accountant, we map your technical reality directly to HMRC's strict criteria, ensuring your claim is optimized and defensible against AI-flagged audits. Contact ProTax Accountant today and secure the capital your innovation has earned.